Hey folks, and welcome to the Pipnotic Symposium for the 7th of August 2021. Today we're going to talk about divergence and look at some price patterns that are emerging at areas when divergence is occurring on the histogram. And now if you look at divergence, a pretty easy pattern to identify. You have higher highs in price and you have lower lows using histograms or any oscillator for that matter. But something very specific is going on, and today we're going to spend a little bit of time into trying to understand what it is precisely that's going on during these times when you're seeing divergence play out on a price chart. Okay, and there's a trade that I took yesterday on the pound American dollars a little bit later in the day, and it was based on what you can see just here. And so very clearly you could see that we had reached a historical high if you look left, and we started to show signs of divergence, and the divergence was visible long before I took this trade. So we had, and it's located just here, so we had this sideways price movement from here, oops, so from here to here. And to do that actually a little bit more accurately, I'll do it here. So the software found this okay here, but it was after the release, which is very typical for the software. It waits until we have confirmation essentially. And so if we look at this, you know what, I'm going to zoom in a little bit so we have more clarity and go like this so we can focus on this. So looking at this, you can see very clearly that we have sideways price movement. Okay, when you have something like this, you'll notice that in the situation of divergence where you have the price going higher just ever so slightly there, and then you have the histogram going lower, and this will often happen during a time of accumulation or distribution. And here we had distribution. Okay, so price was moving sideways. We didn't know that this was distribution until price left and price started to sell off. But notice we had a high just here. We had the highs of these candles just here, and we had the bottom, the body of this candle, the body of this candle, the low of this candle here, and some of the candles in here. And then you notice that price went outside of the range a couple of times to the upside and to the downside. But what's interesting to us here is that the price, oops, I didn't mean to do that. Let me put it back on. Come on. So price did something like this where it came up, formed this high, it went low, and this is when we had the divergence occurring. Okay, so we had a high, we had the histograms doing something very different. So this is telling us something about the underlying value of this currency pair, the pound American dollar. Okay, so price did this and then it left. Okay, and when price wriggles higher, we spoke about this in a previous symposium, where price is it's trying to find liquidity that's available in the market to drive price in the direction that is necessary to fill whatever orders are on the books of the entity that is pricing this asset. So you have price moving higher, it moves lower, so we're also looking to remove some rather search for some liquidity available at the lower edge of this box. And this is simply because if you think of the motivation of traders when price is moving sideways, if price breaks out like it does, people put their stops in very predictable areas. Okay, so for this, for example, if price would have popped up above here and you had a trader who thought that this was a sign that price was going to continue moving north, well, they're going to be looking at significant lows or historical lows to place their stops. So their stops are going to be located under the previous swing points like so. Okay, price goes higher, then it pulls back in. Okay, so this is like a trick. Price has rallied higher, and then price came down, and now we have to shake people out of their positions to release liquidity into the market so that it can be used to fill the orders, the bigger orders that are on the books of these institutions. And so if you consider a cup, for example, the cup is filled with water, it has no lid, and if you want the water to get out of the cup, you can just shake the cup. And so shaking the cup up and down will make the water come out of the cup and land on the floor. Okay, and the same thing is happening here. Here we have a cup, is the white box, and price being moved higher and lower is the shaking going on. And so if you have liquidity, if instead of water we have liquidity, which is essentially a different kind of liquidity, it's cash, and moving, shaking the cup or moving price above will cause the water or liquidity to come out. Moving it below will also cause the same thing to happen. And doing it again up here will cause liquidity to be dumped into the market. And when this happens, it is scooped up and it's used to fill the order of the institution that has an order that needs filling. Okay, and so now the cup is filled, and now we see the real intention behind this this liquidity exploration. Okay, so price wriggles south, it wriggles north, it wriggles south, it wriggles north, and now it moves south. And now the software is showing us where we have the intention. So this becomes a key level for us. Okay, because often when price is, this isn't a very extreme liquidity exploration. Sometimes you have patterns where you have price going like this, and price will come in, and it'll start to form this sideways price movement, and then it'll go lower, and then it'll go really high, and then it'll go down. Okay, and then we form this box. The software normally do this. It'll find this area here, and this is where price will return to before it leaves, like so. Okay, and when you see something like this, if you see price move much further north, much further beyond the upper area of this area of distribution, well, this, you know that the pancakes available above here or in here are going to be removed, and so doing this is really advertising a cheap price. So price, the pancakes at the upper edge of this box are gone. We're starting to advertise very high prices for sellers. Okay, we also have people who have their, if I remove some of these drawings, you also know, if we focus on how people are positioned, when price came back in here, then a lot of people said, oh, actually we're going short, so they put their stops up here. Okay, price goes down, they think they're right, and then price has rallied one last time to remove this, to dump liquidity on the floor, which is then scooped up and used to fill the bigger orders that the entities who are creating a marketplace for us are able to use to fill these orders. Okay, and so price leaves. And so you have to notice that when price really goes north, like we have like this, price really goes north and then it goes down, some of the banks have to buy to get price to move this high. You can't just say that this is what the price is, we're going to start trading higher. You actually have to drive the bank up there, and so, sorry, the price of the asset higher. And so the price will go higher. We start to fill those big orders that they have in their books, and then price leaves. Okay, but notice that because they bought here, maybe from here, and they continue to buy here, when price goes down, they're exposed to the long positions that they had to take on in order to drive price beyond this little box. When that happens, there's almost always going to be a way, or there has to be a way for them to rebalance or to remove their risk from the trade. And so when you see something like this, okay, you have a liquidity void, there's no trading in this, price will come back, okay, and then the orders that are used to cause price to rally north to form this divergence that we saw, they will be closed off at a small loss or at a break even or a small profit, and then this is when the market starts to move in the direction that is advantageous for the bank, for the institution who has these orders to fill. Okay, and you'll see this over and over and over again. If we look at what happened here, yeah, price came up to there and then we left. Okay, so now the positions taken to drive price north, they've been closed off, or most of them have, and for the ones that are remaining, well, then they'll have to just endure that risk until price comes back, or introduce mitigation measures in order to reduce the risk associated with pushing prices higher. But the order's filled and now price starts to move. And so when you see something like that, also notice that we have an area of demand here. We have the buy zone here, just here. And so this is still unbalanced. We have a liquidity void here, price is out of balance, and this has to rebalance. And so the natural direction for price to move in a situation like this is down to here in order to rebalance this price inefficiency that you can see here. The beginning of the buy zone is just here, and so we'll probably start to see the buying begin at the lows of this here, but we still have to move down to this to the origin of the move that caused this price structure. Okay, and so I got into the trade around here. We had a parent area of supply, we had the child that formed, price tested it, I waited for a little bit of a confirmation, and later yesterday I sold at market around here. Okay, and I got out pretty early actually. Where did I get out? This was actually a 15-minute trade, and it was actually, I believe it was the lows either here or the low of this candle here that left. It's a very small trade just before the weekend. And now price is looking to do what? It's looking to rebalance this price inefficiency, okay? And it will start doing that from the point where price returns to the buy zone, which is down here. I'm going to leave it at that. If you have any questions, please let me know, and have a great weekend.